getting a patent on it, and that changes the law quite a bit. So and of course, filing a provisional patent doesn't really, it probably should be done through a lawyer, in my opinion, but if you want to do it without one, it doesn't cost very much and it isn't all that hard to do. And I think it just makes sense to do it. But the primary reason I said that is because I've seen many small companies being eaten alive early on because they made this legal mistake or that legal mistake early in their formation, ranging all the way from not having their stock distribution plan set up properly, or their, a bully company comes along and victimizes them with a lawsuit. I gave an example in Rawls' session. And so, I mean, you and I agree about 80% of all things, but not on this. I tell students when they're starting up, if they can raise $25,000 to $50,000 to deal with legal fees in the first year, do it and spend it. And I told the example of when Mail the World was sued because they thought we were a small company by a big company back west. We were happy to be using Noby, Martin, Olson, and Bear as a lawyer at the time. So I called them up and I said, okay, send all your stuff to Noby, Martin, Olson, and Bear. And we never heard from them again, just as soon as I saw that, because they knew they weren't going to be able to bully us because we were using that firm. And so, there's two sides of this. You could get by cheap on this stuff, but sometimes I think it does. I think it's important to talk to lawyers, if nothing else, from day one. Even when you're trying to figure out who owns what, I think it's important to talk to lawyers. I wouldn't use online guides or something. I would spend $500 and talk to a good attorney about that. So Ron and I disagree with you officially.
Good. Officially noted. Now, on to the next section. We have our guest speakers here. Woo! Thanks, guys. Joe and Chris, both Harvey. I guess you were contemporaries. Chris was 2000, right? And yeah, Joe, class of 97, who have had divergent paths that sort of ended up in similar places, I think, in the end.
Yeah, you never know how it's going to work.
Yeah. Let's see. I mean, why don't we just first talk a little bit, just tell us about yourselves, how your career went after you graduated from Harvey Mudd until yesterday, in like 2 or 3 minutes. Joe?
Yeah, I'll start. So I had a pretty traditional sort of software engineering career early on. I interned at Microsoft a couple of times when I was at Mudd. Started there. I was at Microsoft for 7.5, 8 years. And then I joined this little company called Google, was one of the, first 4 or 5 people in the office in the Seattle area. I never actually moved down to the Bay Area. I've been in Seattle the whole time. And then I was at Google for 10 plus years doing a whole smattering of things. And, just sort of advanced and played the game within, the big company software engineering world. And along the way, was on the ground floor of this open source project that happened to catch fire called Kubernetes. I was kind of burned out, and I don't think Google at that time really recognized the value of what we were doing. So I kind of, went on sabbatical and goofed off for a while. Along the way, I started making some connections to some folks in the VC community and was friendly there. And so got invited to be an entrepreneur in residence at Excel, one of the big VC firms in the Bay. Did that for about a year. And then my partner in crime from Google, product manager, and I then ended up starting a company called Heptio. Did that for 2 years and got a acquisition offer. We did an A round and then a B round. We were looking at doing the C round. And when we were in the middle of our fundraise for the C round, got an acquisition offer that was just too good to pass up. And about 2 years ago, 2 years on December 11th, ask me why I know the date. And we ended up closing the deal to sell the company to VMware. And that's what I've been doing up until then. And so it's like, big company, small company, big company type of thing. It's been an interesting journey along the way. My current position now is like principal engineer at VMware. I think, at some of these levels, all the job titles and responsibilities really start to blur together.
All right, thanks, Joe. How about you, Chris? Since 2000.
All right.
All right.
I've I've had 3 jobs. I was a lifeguard through school, and then followed Ray Granger out of Harvey Mudd to Accenture. Couldn't get one of those cool software engineering jobs at Google or all those places. So I'm definitely a B tier software engineer. That's okay. So B tier software engineers are people too. And then, I did the Accenture thing for about 5 years and was put into healthcare, where I spent the first 3 years trying to get out of healthcare. Why would I want to be in healthcare when I can go to cool things like media and entertainment or high tech? And then I realized, one, the dot-com bubble burst, so healthcare is actually a good place to be. And all Accenture did was install CRM systems. It's not like we were necessarily working on the products or anything like that. But then, met a person who went on to be my co-founder in Instamed, who was also an Accenture consultant. He'd been an entrepreneur before, and tried to get a market offering going at Accenture, kind of around the concept of web services and healthcare commerce interconnectivity between doctors, hospitals, insurance companies. Those are the types of things we were working on there. And of course, couldn't get anything off the ground. So started a business on our own, and really kind of doubled down on the concept of payments within healthcare. That the name Instamed, is a healthcare reference. And right around when the HSAs passed, and, back, believe it or not, 20 years ago, you'd go to the doctor, you'd pay $5 and you were done. Some people remember that. Now you go to the doctor, you take out a mortgage and leverage your credit card in order to pay for it. But that trend was starting as we started the business. So 15-year overnight success story, and build a business up, took on investments from several banks and strategics and venture. And, we have an interesting fundraising story I'll talk through, but, we had to be sort of patient. It was not a overnight scenario, patient in our capital raises and all those types of things. But eventually, build a pretty nice business, and eventually looked at either raising more money and probably going down the PE route, private equity, but ended up going to the strategic, and that's JP Morgan, who purchased us July of last year. So it's been, a little, year and a half, somewhere in there, and part of JP Morgan now, which, so was part of Accenture before, but you're always on a small team at a big company. It was like the consultants who would stay late and get things done, and now part of the big machine. So now I run basically the product and technology for the healthcare portion of JP Morgan, really their wholesale payments, because a business like JP Morgan has, they have healthcare investment bankers and all this kind of thing. So, doing what I can to make things happen in the big machine of a big bank. So I'm a banker now. So I come 3 o'clock, I have to go play golf every day.
Nice. Well, so today our theme was sort of about, legal stuff, as we were sort of talking about, and negotiations and partnerships. I don't know, whoever wants to talk a little bit about maybe early on in your company, were there key partnerships that how'd you get from 0 to 1? And did that involve negotiations and partnerships, or any advice you'd give yourself 20 years or 4 or 5 years ago that you wish you'd had? Joe will alternate chair.
Yeah, I'm happy to start. I think, I started my career, like I said, at Microsoft. And at the time, Microsoft was, this was, pre and during sort of the whole antitrust consent decree, for those who want to go read the Wikipedia page. You didn't live through it. Microsoft at that time was a hyper aggressive competitor. And the point of view of the company was largely beat the competition versus, what can we do to actually serve our customers? And I think that set me up for a mindset of really sort of zero sum, win versus lose. And, and when I joined Google early on, it was kind of an idealistic company, and it really took me a while to deprogram and actually, shift my thinking towards really focusing on delivering customer value. And so from a sort of a negotiation point of view, I think it's really important to really understand that this isn't about winning or losing. It's about actually finding value for, on both sides, where everybody really sees it as a positive sum type of thing. And I think, so much of what we did at Heptio, but also the open source project, and so the whole premise around open source in general is not viewing things as zero sum, but rather as positive sum, where you can have folks come together and and really bring an attitude of, everybody gains out of the deal versus winning and losing. So I don't know. That's not a super specific example, but I think it is just a change in mindset that was been super useful for me.
The thing I'll add, we definitely, in our business model, we actually rely fairly heavily on partners. So it's become somewhat important. One of the things we'd always talk about, though, and we'd see competitors, is there's a lot of Barney partnerships out there. So one thing I would say is avoid Barney partnerships, where it's like,
what's Barney?
let's get together, do a press release and sing, I love you, you love me.
The dinosaur.
And it tends to be like, we have a product offering in X, someone else has a product offering in Y. Oh, and we could sell to each other's clients. We're going to do a I love you partnership. Like, there's probably examples of those working out, but my personal opinion, for every 20 of those things, like, I bet they get 2 customers total, and it's the 2 they already had. So be careful of Barney partnerships where, there's not a lot of rubber meeting the road. It's just sort of like, hey, we agree to be compatible and we work well with each other. But the things that have worked for us, and at least in our model, is we took on some strategic capital, which definitely comes with a lot of hair on it. There's a lot of things you got to manage around that and negotiate against. But if you can do it the right way, strategic equity that is non-control that comes with a commercial component, can be a pretty powerful way to do things. And in fact, with some of for us, it was banks, a couple, did some equity, and others that acted as distribution to sell our payments product, as they wanted something that was healthcare specific. They could sell the same merchant terminal they could sell to a pizza shop, but how do you integrate into the healthcare environment? And we offered that. And, there's a real partnership there where they can sell, they have a bunch of distribution, we have a product, great. And the equity component often help with that. But it can backfire. It can be really tricky because you do not want to give up control. We were asked, for a great example, we were asked to give up exclusivity. Like, we would only sell through First Bank, saying, hey, you'll only ever have us as a bank distribution channel. And you're like, that's going to really limit our value long-term. So those are the types of things you really have to kind of weigh. And if you can thread the needle and get the distribution and the brand and all those things that go with, this big bank is one of our backers, there's a lot of upside to that, and have a path to, and we brought on 3 other banks as backers too, and distribution partners, where they're not it. But one of the biggest things to watch out for, I think this applies in venture raises and other things like that, when you're negotiating with the bigger players, you gotta be really careful not to cede control without a big check, I guess. And that can happen too. And, we were probably close to it at times. It sounded great to raise that money on those terms. But if you use your lawyers, sorry, Josh, and read the fine print. And it's like, there's a path, especially if you don't hit your numbers, or if you're an eternal optimist as a thing. But if, things go south, you don't hit this number, that number, and all of a sudden that convertible debt can come in, and, all of a sudden you don't own your own company anymore. That, you got to really watch out for those scenarios.
I would say the strategic investment stuff is interesting, because I've been on both sides of it, both looking at taking investment in Heptio, but then also advising both at VMware and Google Ventures, and then VMware has a venture arm, and so does Dell Capital. There's 2 modes there. One of them is that they're just holding an option on you. It's really an investment point of view, and there's not much strategy in it. And then on the other hand, there's places, so where it's the investment arm leading the investment, and you're not going to get a lot of strategic uplift out of that. That really is just sort of just money. But if it's the product teams that are actually looking to expand their business, and then they direct the strategic investment arm to actually make that investment, that's when you're going to actually get a real partnership and an uplift. So, I've seen, like, especially with Google, there were companies that would take investment by Google Ventures and then be like, hey, Google Ventures invested in us. Doesn't mean they're strategic to Google, right? It's, it's just a name without the oomph behind it.
When you're getting these, like, investment terms coming, like, how are you able to push back and, like, not make that exclusive, for example, Chris? Or you had some other options, or you just felt like, walk us through the negotiation tactics, any specifics? Or
Yeah, I mean, you got to have options, or at least bluff that you have options, right? And most of the time, we were fortunate to have a pretty strong angel base, and then some early East Coast based, more patient venture, with a little friendlier terms, so maybe you don't love the valuation, but as long as you have some backup options, that gives you a lot of flexibility. Now, obviously, it's easy to say go have options, but what if you don't have options, But then too, you just have to be willing to, be bold a little bit, and some of it's bluffing a little bit, but like you call it out, like, look, we're not going to give up control unless you buy us, which you can do. You're generally talking to a company where it's a blip either way. So if you want to buy us, buy us. But if not, you got to let us. We'd love to have you on as a partner, but you're going to scare away a lot of business if you do this middle ground, and that's not good for your investment. That's not good for anything. And I think folks get that. They're either going to make the case internally that, hey, this is a down payment on potentially buying these guys. We'll see how they do. Or, hey, we just want to be a piece of this. It's accretive to our business long term. Like in financial services, there's a lot of that. A lot of banks recognize they can't innovate, but they want a piece of the action, and they want to be supportive and be one of the early go-to-market distribution partners for something that's innovative. So I think as long as you just call it out too once you see it, because the other thing that happens is there's a business intent, and then there's lawyers and M&A guys and deal guys and all that. And the deal guys and the lawyers are programmed to optimize, right? Yet you got to go back to the business guy, the product team, whatever it is. And look, are we doing it this way? Or are we doing it that way? Because the deal guys are doing what they do. And is that what you really want?
Yeah, there are definitely times where, they get too into the whatever specific, like we can't.
I mean, if it's your job to optimize,
you cannot sign this, and it's not anything, but it's somebody.
I think this actually drives home the point that any negotiation, any partnership, there is a certain amount of leap of faith here, right? You cannot plan for, you cannot document, you cannot protect yourself against every eventuality. And I think if you overdo it, you kill a deal. I mean, there's the saying, time kills all deals, right? If we were, as part of Heptio, we were looking at picking up this small company in London to help establish a London office. And it was a small couple of founders, and they ran down the clock, and just were too afraid to commit. There wasn't, we're afraid to trust. And, we ended up, it would have been a better option for them to join us than where they ended up going. But it's, you have to be able to build that trust and take a leap of faith. And I think there's lawyers, there's everything comes in, but ultimately there's relationships and people that this stuff comes down to.
I always say, is there someone there you can go have a beer with back channel that actually has some authority? It's not just going to be like, yeah, I'm sorry, you're getting screwed over, but can actually that is kind of invested in making it work. And, is let's talk about this over a beer. If the answer is yes, then you're probably in a good shape. If the answer is no, then find it maybe before you commit to a partnership like that.
I think another aspect here is that it's very easy to view financing as a transactional type of thing. You're a startup, you need money. These people have money, make it happen. But it's really the start of a relationship, especially if they're going to be on your board. And so there ends up being a really sort of asymmetric view of this, where the startup founders, again, view it as a one and done type of thing. The investors have been through it before. They know that they're going to be stuck with you for, years, working with you, helping you through thick and thin, hopefully, if things go well. And so, again, I think, there's the deal, and then there's the relationship and actually living with the deal after the fact. That was definitely a consideration when we sold the company too. Because there were companies that I probably would have sold, but the price would have had to been higher compared to where we ended up. And so, I think when you're making a deal, don't get tunnel vision on some of the numbers. You have to think about the whole picture of what it means to you and to your business and to the investors over time after that deal is done.
Mm-hmm. Yeah, it's a good point that with these negotiations, it's so two-sided. It's funny too, when you're talking, you'll be partners, you're all aligned in something, and then all of a sudden it's time to raise a little more money from them. And it's this weird, so we're friends and we're all aligned, but actually I need a little more money. And then they're like, well, I want to give you you're not worth as much as we were talking about yesterday. There could be this quick flip.
Yeah, they'll play games with you and jerk you around.
And then once the deal's done, we're back. All right, we're realigned. But that's a good way to, like, recenter and be like, we have the same goals, right? Yeah.
Josh, could I ask a follow-up on that one?
Yeah, sure. Yeah, anyone who wants to Q&A in anytime is good, or you put in the chat, or you can talk. Cole?
Yeah, thank you, Josh. Joe, I just said there's a really great point. I guess I'm wondering. I feel like a lot of, from what I've gathered, a lot of venture firms, I'm seeing like kind of community or platform roles, like kind of a proliferation of that. Like you said, there's a relationship there, right? And what's the value beyond maybe the dollar value of your partnership with a given venture firm? I'm wondering like how you would go about weighing maybe the comparative value of like, I mean, the dollar certainly does matter, right? Like you need the money to run the business. But like, I don't know, like where you go about delineating between, well, we're getting this dollar amount at this firm versus this dollar amount, maybe at this valuation at this firm, but, oh, they have a really great like portfolio company partnerships function. And so I guess I'm just wondering how you go about evaluating that value.
Well, I think at the end of the day, like I said, you're going to be, especially if you have somebody join your board, you're going to be working with them a lot. And so there is that fundamental question, is this somebody I want to work with and actually deal with a lot? If they, if you just don't get along, or if you view the person as an asshole, then like that's not a good situation long term. The other, piece of advice here is I think, startups and founding a company is fundamentally a team sport. And a big part of that is knowing yourself, knowing where you're strong, knowing where you're weak, and then finding people who can complement that and help fill in the gaps. The biggest thing you can do is hire well. That's the, every time you get a new employee on board in a startup, it really feels like, a new cylinder in the engine and you can go faster. It's a really exciting experience to see that happen. And so for me, I really valued the relationships where, the investors could really help fill out where we were weak, right? So it's like, I'm an engineer. My partner was a product manager. He was CEO. I was CTO. Now it comes down to marketing and sales. Like, we don't know marketing and sales from whatever, right? I don't even know what a good, like CMO or VP of marketing even looks like, right? To even interview these people. So there's this weird experience where when you're interviewing people and you don't even know what the job is that you're hiring them to do, not in a really visceral way. And so that's a place where I think we got a lot of value out of our investors in terms of introductions, expert advisors on this, the ability to essentially round out our picture and make sure that we were hiring the right leadership roles for these functions that we totally didn't understand ourselves. There are other places where, they'll be able to help you, introduce you to customers and really help sort of get some of your early deals done. And some of that is like, hey, do you have those relationships? Is that what you need right now? Is that something that you see needing down the path? So you have to really be very, very sober about understanding where you're weak and explicitly go to fill in those gaps. Now, how do you value that versus the valuation? I mean, there's no formula here, right? It's fundamentally, when you're doing these things, there's no spreadsheet that you can put numbers to that you can assign a dollar value to these things. You really just have to do your best to
go with lower stress.
Yeah, I mean, at the end of the day, it's stressful enough. If something's going to make your life easier, and I think that was my experience as being an entrepreneur in residence, is that it was really a relationship building experience where they got to know me, I got to know them. When I finally did want to do a startup, it really paved the way and made everything go smooth because we were both known quantities on a human level. And that really, really made things go a lot better and reduced the amount of surprises. It also meant that we could go from like founding the company to, closing the A round in like 2 weeks because we had all those pre-existing relationships in place and we were known quantities.
Cool. Yeah, it makes sense. I appreciate it.
There's a question in the chat from Brooke. I'll just read it. She's, how critical do you feel it is to capture the details of a partnership in a legal agreement versus more informally? I guess in an early stage, she's like, we're leaning more towards more formally, but anyway, thoughts on that?
I'll take that. It depends a little bit on the nature of the partnership, but I get people calling me every day telling me they want to partner with me, which basically means they want to sell to me. So that's pretty important to have a contract in place, right? So if it's a Barney partnership, no. But if there's money changing hands and things like that, great. But you're also, I think obviously if there's an economic arrangement, you got to have a contract to codify that. If it's sort of a, hey, you guys will sell or help, those are really hard to codify, but I go to economic stuff needs to be clear. Outside of that, like non-economic commitments and stuff like that, I wouldn't place a lot of stock in it, so like, hey, you agree to to refer people to our platform because it's good for you. Like, yeah, if there's a rev share or something as part of it, yeah, lock that in. It's really hard to get them to commit to a certain number of leads or something like that without it being like, you get a 10% referral based on this, but if you sell more, like you say you're going to do, then you get a 30%, it all goes back to the numbers in my mind. Because outside of that, it's really hard to enforce anything and you just get bad feelings and all that. So, yeah.
I mean, I would say understand how bad things can go, right? If you're talking like, oh, this is going to be, if this whole thing falls apart, it's a 10 grand thing, like whatever, right? Like you can sort of sweep that under the rug. If it's going to be, $1 million early on in the company, yeah, you better be a lot more careful of that. So I think a big part of this is just being super pragmatic of understanding sort of what the possible outcomes are and, what the risk profile is, and then figuring out how you want to mitigate that risk.
Yeah. Is there even any value in a just a verbal partnership? Like, what is a verbal partnership? I guess. Is that a thing? I guess it's a Barney one.
I'll see you at this conference next year and we'll have another beer.
Yeah. I think that, yeah. Anybody have more questions now, or should we?
Josh, I just,
go ahead,
I think, I just add to that. As soon as there's money involved, one of the things you do want to document is you obviously want to get the economic terms right. But if it's delivery of something, it's crucial to your sales process or your implementation process, you want resourcing, you want roles and responsibilities documented in that same document so that you can go back to it to tie money to performance as best you can. So I think, that's when you really want to, if it's part of your go-to-market, you want to make sure you've got that documented as well.
All right. Here, I'll do one quick. What advice would you give your 5 years ago self? Just 5 years ago. How about that? Not 20, just 5 years ago, 2015. Anything? Have you learned anything in the last 5 years? I guess
go along on N95 masks. I mean,
yeah. Buy Zoom IPO stock.
Right. Has there been any recent wisdom gained in your career in the last 5 years, or was it all over the last 20 years?
I mean, I don't know how you short circuit those lessons. I think part of the problem here is that doing a startup, living through these things, you're essentially getting experience in sort of, fast forward, time. And I think you can't replace that with sort of sending yourself a sentence or a paragraph, right? And so I think part of this is that, telling yourself something from 5 years ago is not a replacement of living through that and gaining that experience. And so I don't know if there's anything I could have told myself that would have replaced, the experiences. I mean, it's like, it could have been like, don't hire this person. They're going to be a pain in the ass, but it's like, that's all part of the experience, honestly.
Yeah, I kind of think the same thing. And going back 5 years, there's things I would have done tactically differently, knowing, do that, don't hire that person, focus on that product feature, not that product feature. But it's hard to know at the time. And most importantly, I think we were patient. We raised ultimately patient capital that didn't come with a lot of ticking clocks. And, it ended up diluting us over time. But I think the one advice I'd give, not something different, is more, if you're kind of going into it, we didn't go in knowing the formula. We kind of went in a little around and all that. You got to be patient. You got to be willing to pivot and have flexibility. So flexibility, optionality is super important. There are scenarios where, hey, especially like round 2, round 3 things, or hey, here's the group of us, we did this here, we can come out, like we've got an idea and now it's strike while the iron's hot, then I think that actually changes the way you both develop the product, even raise capital. You can take a little more valuation terms, because this is a 3-year thing. But if you're not sure, assume you need to be patient, have optionality, roll with the changes. The economy is going to be different in 18 months than it is now, all those types of things, and just think about those things. So it's easy to get stuck on the upside of the optimism, but I think constantly watch the downside and make sure you're not ran completely into a wall if it's harder to raise money in 18 months or whatever, that type of thing. So
yeah, there's it's like, the stove is hot, but you still have to touch it. You got to go through the experiences to really internalize it. Okay, I think so we do a thing now. This is like the breakout rooms, like where everyone gets to rush the stage and talk to you after the panel's over. So I gotta break you guys into 2 different breakout rooms here. And thank you both for coming, and I will move
Thank you for having us
between them. It's awesome.
I appreciate it. Yep.
And happy anniversary, Chris. And I'll just open these up and then move people around as they request. So, all right, thanks. Let's see. Open the rooms. You guys are unassigned, so I'll assign you to your rooms. That's one thing to do. Oh, come on. There we go. I'll put you in the joke.
This is like advanced zooming.
I know. I'm getting sort of okay at it, but I still don't let people screen share too well. Let's see. I'm assigning you to Chris. I'm assigning you to Chris. I'm assigning you to Joe. I'm assigning you to Joe. I'll assign you to Chris. Assigning you to Chris. That's just going Joe. Jeffrey going to Joe.
I was alone in my breakout room. That's why I came back.
Oh, welcome back. Would you like to see Joe or?
I'm not sure.
Josh, could I merge into? I'm trying to merge into. Oh my goodness, not Joe's, but yeah, Chris's.
Okay. Wait, who I still got here? Somebody still here?
Just me.
Oh, hey. I don't understand where you are in this. Let's see. Oh, you're still in the random mentor room. There we go. So did you care? Joe or Chris?
I mean, flip a coin. Who? I mean, you know my situation. So I guess whoever you think is better for me.
Oh, they needed Joe. I don't know. Baby Chris. Oh well. Professor Evans. Oh, they wanted Joe.
Somewhat similar space, may or may not still be around. Maybe you could find out who invested in them and